Well, joining me now with more is our resident expert, Jay Woods. He's a chief global strategist at Freedom Capital Markets. Jay, always good to see you in studio, especially after a day like yesterday. Where does this leave us?
Yeah, we were talking last time I was here about different levels that we were watching. The level around the election, 5783. The S&P 500 eclipsed that and is still trading above it. The 200-day moving average. So these are signs of progress that price action is showing us that maybe the worst is behind us and we're trying to stabilize. And then you talk about the fear and the angst that's been in this market. You measure that by looking at the VIX. The VIX, which spiked to 60 back on April 2nd, now is trading at 1775, so under 20. So things are finally calming down. People are exhaling. The news isn't coming at us as quickly as it once was, and the news that comes at us is a de-escalation of some of the trade war talk that we continued to see for weeks.
Now, on top of that, we did see inflation data for April earlier this morning before the market opened. That was pretty much in line and getting closer toward the Fed's 2% long-term target. How does that factor in?
Yeah, well, that shows you that the hard data, the actual factual data that comes in, the CPI today, is still cooling off, is not elevated as much as people feared, because the sentiment, those readings were at record highs. We expect the tariffs to cause, sky high inflation, and we still should see inflation tick up. But right now, all those fears have been kind of cast aside as we're focused on the actual data that comes in, and energy prices continue to go down. Those grocery prices which spiked, those egg prices which spiked, are starting to come in a little bit, making some progress. But a lot of this is pulled forward because people ran out. They got what they needed. So we'll see Q1 versus Q2. Now that we're in Q2, let's see what the next few data points are. Yeah. We average that out. It shouldn't be as bad as people think. And this is good news for those, especially at the Fed, worried that, okay, the tariffs are going to cause all these problems. As we start to negotiate these tariffs, yes, they were kicked down the road again, especially with China. They're not as bad as the worst fears. So those worst fears are behind us, and now we'll see where they go. I don't think we're going to run off to all-time new highs, but that sigh of relief, that trading above the 200-day moving average, which to me as a technician is a barometer of health. These are good steps in the right direction, and we'll see where we go from there.
We've been starting to see comments about a V-shaped recovery. For our viewers, what exactly does a V-shaped recovery entail?
All right, a V-shape, well, the first part's not good. The first part means we fell off a cliff, and we just saw that, from Liberation Day, actually from February 19th to the bottom of the S&P 500 sell-off on April 7th. We dropped 19.2% on a closing basis. Intraday, we were over 20%, which would, make it a bear market. And then we've snapped back. So when you see a drop and then a recovery that's just as quick, it forms a V on a chart. So V-shaped recoveries usually happen because of some shocking event to the system. It happened during COVID. Everyone remembers how quickly, down 30% in 35 days. Took 2 months to recover back to the 200-day moving average. Here, it took us 5 weeks to recover back to the 200 moving average. So we saw the sharp sell-off. We're getting that sharp recovery. Now the question to fill this V, will we get back to all-time highs and go above that? I don't know, but this has been a sharper and faster recovery than most pundits, including myself, saw. I did not expect us to be this far ahead of where we were, given that tariffs are still up, tariffs are still uncertain, and we're not sure exactly where this is going to settle out. But to recover and be back above election day levels, to me, is a great step in the first direction.
So to keep it in perspective, Jay, you referenced that the worst is probably behind us. And we've heard other guests on this show say the same thing. Does that mean we are out of the woods going forward?
Yeah, nice pun there. I see what you did. Out of the woods. No, I don't think we're out of the woods by any stretch. We're looking at individual earnings. So it's earnings season. We have a big one on Thursday, Walmart. Walmart last quarter, you talk about stocks that got hammered and they're coming back. Walmart's a perfect example. They had a solid earnings, but their earnings guide was less than anticipated. So they saw, trouble ahead. Now let's see what they say. The quarter, they'll probably beat their estimates, but what is that guide? What do they say as far as inventory levels go, as far as the consumer spend goes? If they give us some guidance that really is a picture to the average American consumer. So Walmart's going to be very interesting when they report on Thursday. The stock has not made it back to new highs. I think the old high was 105 to 110 level. It got back to 97 and then starting to fade a little bit. So the price action going into earnings is a little trepidatious, but we'll see if we can get a solid quarter, a solid guide, and that will probably be a big tailwind for this market if we want to go to new highs soon.
The other major factor that you know well is the Fed. And I had an economist on from Nomura, NYSE listed company, earlier in the show, and he referenced that he does not think the Fed will cut rates until December.
Yeah.
What would that mean?
Till December, wow, that would not make the president happy, first and foremost. I know Washington is not going to be happy with that. The Fed said all the not right, not wrong, what's the Goldilocks kind of line, that things are okay, we can cut, but we want to wait for the tariff data. I still think tariffs are going to dictate what the Fed does. The inflationary data, the unemployment data has been stabilized. They can cut. So I would disagree. I don't think we're going to wait till December. I think we could get one as early as June, especially given the recent data. They have a few more big data points, another CPI, another PCE, 2 unemployment numbers before they meet in June. So to me, if Powell is a man of his word, one data point at a time, and the data keeps coming in like this, they can cut at least a quarter of a point at the next meeting, if not by July. So to wait till December, I don't know what we'd wait for if this data keeps coming in the way it is.
Good betting game, that's for sure.
I'll take the other side of that December call on the heartbeat.
All right, Jay Woods, Chief Global Strategist here at Freedom Capital Markets. Jay, thank you as always.
Thank you.